welcome everyone, and thank you for joining us today for the inaugural Brattle Prize webinar. I'm very pleased to welcome everyone, and my name is Antoinette Schoar. I'm the executive editor of the Journal of Finance. I'm here with the winners of the Brattle Prize of this year, Veronica Rappoport, Danielle Paravisini, and Philipp Schnabl. Welcome and congratulations again. I'm also really pleased to welcome a few people from the Brattle Group. This is a firm that has sponsored this prestigious award now for 25 years for papers in corporate finance. If you are not familiar with the Brattle Group, it's a consulting firm that answers complex questions in economics, finance, in regulatory environment for global firms, companies, law firms, governments. Brattle works on finance topics ranging from crypto and derivatives to bankruptcy and restructuring, and also works on regularly collaborates with the academic community on research and expert testimony. I'm really pleased that Brattle's president Torben Voetman and principal Shastri Sandri are here today and will pose a few questions to our winners as well from the perspective of the industry. But before we get started with the presentation, let me invite Torben to say a few welcoming words to the participants as well. Torben, may I pass to you?
You may. Thanks, Antoinette, and I appreciate the invitation to come here today to this webinar. The Brattle Group are very proud to be a sponsor of this prize. We have a long-standing affiliation with the Journal of Finance. It goes back to the founder of Brattle, which was Stu Myers. I don't know that anyone needs an introduction to Stu. So our DNA is really our commitment to broaden the academic community in corporate finance and work with that community. And it goes back to our training and development from Stu and what he embodied in us at the Brattle Group. So corporate finance is really important to Brattle, and I want to take a chance just to not only acknowledge these winners today, we're going to hear from today, but also the winners over the last 25 years. We have 25 years of winners and runners-up, and it's a great community, and we appreciate that affiliation with Journal of Finance. And we look forward to continue to work with the Journal of Finance going forward and collaborate with you to invite more research and talk to more winners. So thanks for inviting us again.
Yeah, and thank you from our side, obviously, for being such a great partner to the Journal of Finance. So with this, let me turn it over to Veronica Rappoport, who will be presenting this year's winning paper called Specialization in Bank Lending, Evidence from Exporting Firms. Veronica, the floor is yours.
Well, thanks a lot, Antoinette, and the Journal of Finance in more broadly. And thanks a lot to Shastri and to Tobin and to the entire Brattle Group of this enormous honor. So we are very honored to present this paper today here. And Danielle Paravisini and Philipp Schnabl are also here today, and hopefully you will hear their voices during the Q&A session later on. But I would like to start a little bit in this presentation, telling you how this agenda of bank specialization started. We were working together on a previous project using this data on bank credit and exports by Peruvian firm, when we realized that firms borrowing from different banks were themselves very different in terms of their product mix and in their export destinations. We realized at that point that banks were concentrating their lending in firms that belong to a specific industry or that were exporting to a specific country of destination. And for you to get an idea of what we mean by this, I'm going to be more precise in how this measure is constructed. But what you see in this graph is a visual representation of two specific destinations. You have Switzerland in red, and you have the US in blue triangles. And we pick these two countries that represent, in the case of Switzerland, 9% of total Peruvian exports, and the US represent 20% of Peruvian exports. So this 9% and 20% gives us a little bit of an idea of what we would expect the shares of lending the portfolio of loan would be if the banks held the diversified market-weighted portfolio across exporters towards different destinations. But we see that we do not see that banks have around 9% of loans allocated to exports to Switzerland, or around 20% of loans are allocated to exporters to the US. So for you to have an example, if you want to focus on the case of Citibank, a bank that we all know, only about 5% of Citibank's loan portfolio is assigned to exporters to the US, well below the average weight of US export of 20% in Peru. And in contrast, Citibank allocates more than 50% of its loans towards firms that export to Switzerland. That is way above that 9% weight of Switzerland in total Peruvian exports. So it turns out that Citibank's sharp deviation from that ideal market portfolio, it was not an anomaly in our database, but turns out to be the norm in our data, and hopefully, as you're going to see, in other contexts as well. So we wanted to systematize that intuition, and we constructed a measure of a specialization reminiscent, if you are from the international trade literature, is reminiscent to the Balazar's index of revealed comparative advantage. So we cannot observe really loans going towards a destination, and money is fungible at the inside of the firm. So formally what we did is we measured banks' loans to each firm. So this is what we call L loans of Bank B to firm I. I don't know if you can you see the pointing here? Perfect. And we weight that to the export of firm I to each country of destination C. And we measure that relative to the overall lending towards all destinations by the bank. In all the results that I'm going to show you today, we are going to look at quartiles of a specialization for a specific country. And we're going to say that a bank is specialized in country C if that share of bank lending towards country C is in the fourth quartile of the distribution of that specific country. So why we do it that way? Because since this measure is always relative to all banks in the same country, this measure is not going to be mechanically driven by the size of the export market. And if you notice, what we have here is the overall size of the bank. So we are talking about shares of loan in the whole portfolio of the bank. So this measure is not mechanically driven by the size of the bank either. So doing that, we constructed this measure of specialization for all banks and all exports. This table shows some statistics about the distribution of this measure across all banks for the main 10 destinations in Peruvian exports. If you look at the column mean here, and if you look at the column export share here, you can see already what I suggested in that example at the beginning, that those countries that are higher in terms of the participation in exports tend to also have a higher average participation in the portfolio of bank loans, and typically in all the banks. But there's a big standard deviation and a very high skewness. So let me illustrate this for the case of Spain. Spain on average allocates 3.1% of the loan portfolio to exporters going to Spain. And it's very similar, if you see, to the weight of Spain in total exports. But the standard deviation is 6.6 percentage points, and the distribution is very highly skewed. So there's going to be some banks that have an abnormally high portfolio share of loan allocated towards Spain. And we use that portfolio share distribution to identify specialized banks. We define a bank to be specialized in a country if it's at the tail or at least at the fourth quartile of that specific country distribution. And that measure of a specialization is quite persistent. If a bank is in the top quartile of a given destination, it's more likely going to stay in that top quarter for the following years. So the main goal of this paper was to rigorously test whether these observed specialization patterns are driven by an underlying bank lending advantage towards that activity, in our case, that export destination. So we wanted to answer really that question. Are banks that are specialized in a given destination actually better at providing financial services to firms that engage in those activities? And hopefully you can agree with us that the answer is yes. In answer to this, we're gonna do two tests, and we're gonna use data from Peru between 1994 and 2010. We're gonna exploit the universe of customs documents, and from there we got what each firm in Peru export to every destination and product. And we're going to merge that with the credit registry with information on the universe of outstanding bank credit between each bank and each firm. And we're gonna do two tests that basically follow this revealed preference logic. First, we're gonna check whether firms are more likely to start a relationship with a specialized bank after they start exporting to the market of a specialization. And second, we're going to check whether firms that suffered an exogenous demand shock from a specific export market disproportionately change the demand of credit from a bank that specializes in that shocked country. These two tests are basically going to tell us that even if we do not observe the specifics of that lending advantage, the firms do, and the firms therefore react by borrowing from these specialized banks when they have a shock to the market of a specialization. And finally, I want to take this opportunity to mention some very exciting new research by colleagues that validate our conclusions on this lending advantage. So let me go now to the first test. We're going to check whether the probability that the firm starts a new banking relationship increases after it starts exporting towards the country of a specialization. So we're going to estimate a linear probability model, the probability that the firm I has a loan with bank B at time t and didn't have a loan with that bank before. The left-hand side variable is going to be having entered to the particular market C at the year before t-1 and was not exporting to that country before in year t-1 and previous years. And we're gonna see whether that probability changes depending on whether that bank here is specialized in that country that is newly incorporated in the basket in the set of exports by the firm. So we have the bottom quantile, which is not specialized at all, is dropped here. We have the second quartile, the third quartile, and what we call a specialized bank in the fourth quartile of the distribution. So this regression is saturated. It has firm time fixed effect, from bank fixed effect and bank time fixed effect. What we find is that exporting to a new destination decreases given all these fixed effects. The probability of starting a new banking relationship with the non-specialized bank, with the bank in the bottom quartile of the distribution by 1.07 percentage point, while it increases monotonically with the level of specialization. And actually, for a fully specialized bank in the fourth quarter of a specialization, it increases by 0.82 percentage point, which is the difference between the omitted quartile and this fourth quartile. And this is really a large effect because this extensive margin, if you see from the observation, it has all the potential combinations of countries and that the firm can enter and all the potential combination of banks that the firms could enter at a given point in time. So the baseline and conditional probability of a new banking relationship for a firm is only 0.74%, and it increases to 1.56% for when the bank it coincides in a specialization with the new market that is now served by the firm. The second test, the second revealed preference test that we perform is now on the intensive margin of trade and the intensive margin of lending. We look whether the demand shock in the destination market increases firms' demand for credit from banks specialized in that specific destination. What we do to isolate empirically the effect of an export demand shock, what we do is we instrument exports to a country C with two macroeconomic performance measures in that destination countries that are exogenous to the Peruvian firms. One is the real appreciation in the destination market relative to Peru, and the other one is GDP growth in that destination market. This regression has firm time fixed effect, so what we have here is how a firm increases export to a particular country relative to other exports by the firm when that particular country experiences a boom in terms of economic activity or relative prices. In this table on the left, we have that first stage. The estimates correspond to the elasticities of GDP growth and real appreciation. And in the graph, in the table on the right, we show the effect of a change in export demand using that those macroeconomic shocks as an instrument. And we want to see how an increase in export demand for that specific firm affects the demand for credit. And we're going to see here that the estimates implies that when a firm experiences an increase in export demand from country C, they borrow more from all banks on average, but the increase in borrowing is more than 50% larger for the banks specialized in country C. And in here, we have that happens for both the top quartile and the second top quartile. So overall, we see that there's a systematic behavior from the point of view of the firm, that this measure of a specialization is capturing an actual lending advantage, we think, because there's a systematic link between firms' export across destination and borrowing across banks. Every time the firm reshuffles the portfolio of export markets in favor of one market, there's a mimicking movement across the portfolio of credit across different banks. Before continuing with our results, I would like to mention some exciting new research that further explores what's behind these banks' lending advantages. I want to mention a couple of papers, and as usual, when you do this, I'm going to probably not mention all of the ones I should, because this is quite new, and I'm sure there are other papers that are now exploring this phenomenon. But I want to mention Bickle, Parlatori, and Thunders that apply our measure of specialization to US corporate loans, and Giametti, Gule, and Petrosanti that applied for US syndicated loans. And in both cases, what they measure is a specialization in the industry of the firm rather than the export destination as we do. And they find that loans in the industry of specialization appear to have better terms, which is something we do not always observe in our data set. So they look at the interest rate or the covenants in the case of syndicated loans. So loans by the same markets, loans by the same bank, when they apply to firm in the industry of a specialization, seem to have more convenient terms than when they lend towards firms in other industries. And moreover, these loans to firms in the industry of a specialization default less. So they take this as evidence that these firms are better at screening projects of firms in better way when they belong to the industry of a specialization. I also want to mention Bonfin and De Haas that find something similar when looking at the specialization of branches within a bank and in lending towards startups, towards young firms. So they find that branches specializing young firms are better, again, at screening the best candidates. And these young firms grow faster. They have better survival rate than young firms selected by non-specialized branches, sometimes in the same bank. So it looks like this, even the loan officer seems to understand better the market. So hopefully we'll find more exciting news on this, but I wanted to bring this to your consideration because first we learn more in how we observe this lending advantage, but also it validates that what we observe for Peru, we actually see it in the US, in Portugal, in developed economies, and you're gonna see also in France or in Italy. Okay, so what I want to do now is we have established that observed specialization patterns seem to be reflecting an actual advantage in lending. So what I want to discuss now is some implications. I'm going to explore 3 issues now, but it's going to become more, so probably we can discuss or speculate more in the Q&As because I won't have an answer to all the potential implications of what a specialization means. So the first thing that I want to show you is something we explore in the paper. We cannot treat different banks as substitutable sources of funding because a specialized bank with superior knowledge of an activity are difficult to substitute with another non-specialized bank. I will show you what happens to firms, exports, when a specialized bank changes the supply of credit. The second thing I'm going to show you follows from that first point. It is how should we think of concentration of market power in the banking sector? What is the most relevant market definition if we have a specialization in lending? And finally, I want to briefly discuss the flip side of bank specialization, which is under diversification of the bank portfolio. What does it mean for the transmission of shocks or for the amplification of shocks? Okay, so to assess the first point, how difficult it is to substitute credit from a specialized bank, we built on a previous work, also with Philipp and Daniel, together with Daniel Wolfenson, that I'm not sure if it's here. So in that paper, what we did is we identify a credit supply shock that was driven by Peruvian banks' exposure to the subprime crisis in the US. What you can observe here on the left is a time series of total foreign liability of the Peruvian banking sector. You can see capital inflows into Peru a year before the collapse of Lehman Brothers and a year after the collapse of Lehman Brothers. The middle line here is the collapse of Lehman, and this period between the first and this middle line is the year before Lehman. This period between the middle line and the second and the third line is the 1 year afterwards. On the right-hand side here, this table, you can see the top 10 Peruvian banks ranked by their reliance on foreign liabilities. Banks with the share of foreign liabilities to total assets that are above the mean are highlighted here in red. And these banks cut credit the most during the year post-Lehman Brothers. So these banks, signaled in red, were more reliant on these capital inflows that basically reversed after the collapse of Lehman. So we use this idea of exposure to the crisis as an instrument for credit supply. And what we do here in this table is to measure the effect of credit supply on export by the related firms. We call this credit supply because we instrumented with that exposure to the capital flow reversal. In the first column, we replicate the finding in that first paper from 2015. A 1% reduction in credit supply implied on average almost 0.20% drop in the firm's exports. This is what we found at that time. Now, in the second column, we split the result by the bank country of specialization of the exposed bank. And we find a very stark result. The credit supply shock only affects exports to the bank country of specialization. And in this case, the effect is really large. So if we see, it's not that this bank didn't suffer credit supply shock, it did, but the firms were able to substitute that source of credit supply when it came to exporting to a country that is not a country of specialization. Now, when the shock affected the credit supply, there's one destination for which exports actually suffered a lot, which is the country in which that exposed bank is specialized. This result takes us to a second implication concerning how to assess market concentration. I want to stop here for a clarification point. Notice that our measure of specialization is not a measure of market concentration. A small bank could be very, very specialized and still have a negligible size in terms of the market that is specialized on. And vice versa, there could be an enormous bank that is perfectly diversified and have an enormous, and is very, very large in every industry of operation. So if we want to see a measure of market corporate loans, a concentration in corporate loans, we need to take into account specialization, not because it's a measure of concentration, but because the specialization is a force against substitution in sources of funding. And at the end of the day, market concentration, or how to define a market, is really about that elasticity of substitution. It's an empirical question, whether a firm can substitute one source of funding with another source of funding, either across regions or across industries of specialization. So how should we measure banks' market power in corporate loans? This is an empirical question. And on this, I would like to mention a recent work by Daniel Paravisini, joined with Dickeroy, Masset, Sogniac, and Messonnier. And what they do is they use our measure of specialization at the branch level by industry in France. So I borrowed these two graphs from their papers. The plots show heat maps of local bank credit market concentration measured in two different ways. On the left is the usual HHI of lending measured the traditional way, using total market share in each bank by region. On the right, they measure HHI by industry first, and then they take an average of that HHI across their regions. So measured concentration level increased dramatically on the plot on the right relative to the plot of the left. So it indicates that there's a large degree of industry segmentation in local bank lending markets. We do not know what the right one is, because we do not know yet how substitutable it is, sources of funding across regions relative to sources of funding specialized in different industries. But potentially, the results are very, very different. And this paper actually is after a very similar question that the one I just posted. It asks the question whether local specialization of bank branches in France reflect a lending advantage. And the empirical approach is to assess what happens to the availability of credit after branch closure. So I don't want to go much into detail, but what they look is at the specialization of the branch in the industry of the firm relative to the average by the bank. When a branch is closed, that loan is sent to another branch to be administrated by another branch within the bank. So even though the credit was successfully reallocated geographically, the substitution is imperfect. We can see that the total credit to that firm drops after the branch is announced that it's going to be closed and when it's actually closed. And that is a persistent drop in black that you see here and here. But the magnitude of the drop doubles for firms whose account is transferred to a branch less specialized in the industry than the original one. And that extra effect is in red at the time of the announcement of the closure and when it actually closed. So even though the source of credit was successfully reallocated geographically, the substitution is very imperfect. First, we know about relationship lending, and that probably is associated with the effect, even if it has nothing to do with the specialization, the effect of closure here, minus 0.072, minus 0.125. But also, and it's actually as important, is this new source of credit is not specialized in the industry of the firm, and that creates an extra informational advantage as the one we so much know of, which is the relationship lending. The third implication that I would like to discuss is the flip side of a specialization, which is under diversification. And on this, I would like to mention the results of a recent paper with Stefano Federico and Paddy Hassan. In this paper, what we do is we analyze industry-specific shock that affects banks specialized in the industry that suffered the shock. And in turn, they reduce the supply of credit to firms irrespectively of whether the firm is in a sector affected by the shock or not. So let me be more precise. We are following an originated real shock to the firms, which is import competition from China after China entered the WTO, the famous China shock. This shock was very heterogeneous across sectors. As you can see in the graph on the left, the manufacturing sectors more hit by import competition from China, these are in red, suffer an important contraction in employment, and the sectors not competing with China, even in manufacturing, which are there in blue, actually expanded in terms of employment. The graph on the right shows again the different evolution of sectors competing with China in red and sectors not competing with China in blue. But this time we are talking about the value of their non-performing loans. So firms in sectors competing with China increased non-performing loans relative to firms in sectors competing with China. Of course, given that specialized banks are more concentrated in sectors that are defaulting more often, what we observe is in a regular within firm diff and diff specification is that these specialized banks specialized in hit sectors, reduce credit relative to other banks. And they reduce credit starting in 2002, which is the year that China entered the WTO. In this particular graph, I'm restricted the sample to firms that were not affected by the shock at all. So in a nutshell, what we find is that banks specialized in import competing sectors could not offset the negative effect of the China shock on the ratio of non-performing loans, and they cut credit, actually they also raised interest rate, relative to other banks for all the firms, irrespectively of the industry of operation. So in doing that, they amplify the shock to firms that were already affected by competition from China, but they also transmitted it to other firms that were otherwise not affected by the shock. I want to conclude here with some remarks, but above all, I want to leave here some open questions. In this paper, we showed that banks do not hold a diversified portfolio of loans, but instead they seem to be heterogeneous in their exposure to activities of their related firms. I mentioned here two implications of banking specialization that may raise some concerns. First, how to assess market concentration. What is the most relevant definition of market or market concentration that we can use or the regulators can use? But on this, I want to be sure, I mean, specialized banks are better in that specific activity in which they specialize. And if they're better, we expect them to be larger in that activity. We expect them to concentrate more of that activity. So is that necessarily bad? No, I don't think it's necessarily bad. There's the famous good concentration and bad concentration. So we probably need more research to answer. This is at the end of the day an empirical question of what is the right definition of market, and also whether there's some anti-competitive behavior coming from that concentration or not. The second thing I want to mention, again, is the implication of under-diversification. In our study, specialized banks suffer the impact of an activity-specific shock. But I don't want to therefore conclude that portfolio diversification is a desirable feature of banking regulation. Again, this is not necessarily the case. At the end of the day, expertise, superior knowledge on an activity, these are positive attributes. They imply more efficient allocation of resources. But we need to just be aware that it implies some vulnerability if the banks are constrained, or if they're not aware of their exposure to risk. So maybe our focus should be on better understanding or be aware of the trade-off rather than be against that trend in specialization. Because we are observing, I think, an increasing trend in specialized, especially not bank lending. Potentially, these sources of funding exploit that superior lending advantage vis-a-vis traditional banking. But I want to stop here because we're getting to too much speculation. So probably this is a good moment to stop and leave this open question for future research or for Q&A with Philipp and Daniel here.
Let's say congratulations to you, Veronica, Daniel, and Philipp on winning the Brattle Prize in Corporate Finance. Very excited to have you all present this research. A couple of questions. In your paper, you test the assumption of banks being perfectly substitutable sources of funding for firms in which they already have a credit relationship. And this is an important assumption in the literature. I'm curious as to what other identification problems or assumptions in this field that a possibly novel or existing data set could help address.
Philipp, do you want me, can I take this one? Is that okay? Yeah. So I mean, the kind of the unique thing about what we did was that we collected data that allowed us to disaggregate what a firm does, but in which markets it operates, in particular in our application, and link those to the identity of the lenders providing the finance. So kind of if we want to think about our general model of the world, of banks, you know, firms are a collection of activities. Each of those activities requires some funding, and then lenders are heterogeneous in how good they are in providing funding to each of those activities, right? So that's kind of our view of the world. So in appearance, this is a small change relative to the original kind of Kwajalein representation of kind of the equilibrium credit in bank markets, right? So in that representation of the world, credit was determined by a demand factor, right? So firm demand, which in expectation would affect all lenders the same. A bank supply factor, which in expectation would affect all firms the same way. So, you know, it seems like a small change, but it affects dramatically the way we can interpret the data. So, for example, in the simple firm factor and bank factor view of the world, you have data at the firm bank time level, and you run a regression of credit on a set of firm dummies and a set of bank dummies. The firm dummies will be demand, the bank dummies will be supply, and you're done, right? So you just don't, that's all you need. All you need is the right data, do a variance decomposition, and you have demand and supply. In our representation of the world, and I think we've demonstrated that our representation is probably a more accurate one of the world, you can no longer do that. So, for example, if you posit that a firm has a demand shock, then you have to ask yourself the question: so why is demand changing, right? Are you changing demand because you want to stop exporting to China? Then that means that you're going to basically borrow less from the bank that does China better, right? So they no longer demand shocks can be easily identified just by looking at aggregate movements at the firm level. With supply of credits, exactly the same thing. You saw that the example Veronica gave, or the regression Veronica gave you. If you have a bank can stops lending, and you want to basically try to trace down the impact of this on credit and economic activity, the first thing you need to ask is, well, what is that bank good at? Because whatever that bank is good at, that is going to be those firms that borrow from the bank because it's an activity that this bank does better than everybody else. That's the credit that's going to be difficult to substitute, and so that's the credit that those are the firms that are going to be affected. So it kind of, I think one of the general points that you take away from what we're doing is that this variance decomposition approach of identifying demand and supply is very useful, and as you see, because all you need is the data, and you just run a regression on fixed effects, and you're done. In some applications, and we kind of believe that bank lending is one of those applications. This approach is always going to give you a partial view and potentially a wrong view of what is demand and what is supply. But I'm going to stop there. So you can keep, if I can, you get me going on this question, I can go on for 2 hours. So.
Yes, we have our follow-up webinar.
Exactly.
And then, Veronica, I guess your paper discusses how your findings have implications for the real economy and bank credit markets. And you, Veronica, presented new evidence that ties into your findings, and you briefly talked about some implications. I was wondering if you could expand on any policy implications a bit more. And this is open to everyone. It was more Veronica had presented the evidence, but
yeah. So I am probably the wrong person to ask for policy implications, because I'm always really afraid of giving policy implications. I just everything to me about policy implications explained in a sentence can be taken so wrongly that ends up being a disaster. But so what I would like to say about this is that it definitely challenges our view of how to regulate market power or market concentration. On that, I think we need to have an empirical view of how to define markets. And to define markets, we need to, the market is defined according to substitution. How is it substitute? For example, we tend to define markets as regional. Maybe regional is not anymore the right or the prevalent barrier for substituting sources of lending. Maybe given the new technology or maybe the new sources of lending, regional is not so relevant as market of specialization. So I don't think we need to have a dogmatic view on this. We just need to have better research on how to define market. Also, once we define market and we find high concentration, that is not necessarily something bad if concentration is coming from a superior technology or from a superior efficiency at doing things. So it just we need to be aware that that is a potential concern and just check for potential anti-competitive behavior. One thing that we are currently trying to do is try to understand markups and whether markups correspond to this market specialization. And the same goes for what we say about under diversification. Under diversification, it's not necessarily something wrong. Why is it that they have to diversify in their portfolio of loans? Maybe they can diversify with additional financial instruments and take advantage of what they do better. So it's not obvious that you need to diversify by your own a portfolio, but diversifying your own portfolio of loans. If what you do better is this type of loans, it's just you need to know that that is a source of risk that needs to be hedged. So again, I am very cautious when it comes to policy advice. I just think we need to be better at diagnostics.
That makes sense. And I believe the original Philipp wanted to chime in.
Yeah, so very brief. I mean, I have to say, Veronica, I think, is the only one among us who actually was a policymaker at some point. So I'll defer to her. But just a very short comment. You know, I think in some sense we're building on this large relationship lending literature, which tended to focus very much on information the bank collects about the specific firm. And, you know, part of what's new in our paper is sort of this idea that banks have certain expertise in terms of dealing with particular industries, export markets. I would say it goes beyond lending. It actually is also true on the deposit side in terms of, you know, deposit as a service, what kind of services to provide. And so I think there's a big question about market power in banking, which goes beyond, includes the original literature, but goes beyond it. And so our paper, in some sense, is trying to put a spotlight onto that market power. And I think that's something we have to understand better.
Thank you. Let me also actually chime in here because, you know, I think it's really important what you're highlighting about the interaction between market power and specialization. And, you know, in the chat, I had a question that, you know, actually several people in the Q&A also are bringing up, which is in a way, specialization itself, however, right, might be something that banks can invest in if they so choose. Or do you see it rather as something that's the side effect of some activity that they happen to be in? Because that in itself might then again, you know, mean that the power that comes from specialization could be changing over time if it's something that banks can actually invest in, rather than it's somehow, you know, kind of an unintended consequence of something that they maybe themselves don't know where the expertise comes from. And I wonder whether either you have a view on this or whether there is already some work that could speak to that question.
I have an anecdote. I'll share an anecdote. So we were very concerned. We're not concerned, but we were very curious about this question because, I mean, when we in fact one of the banks we used in our examples often at the beginning was HSBC, and HSBC in Peru appears to be specialized in China, right? So for HSBC, it could make sense that for HSBC had a kind of a global view that they should be the best bank financing exporters to China, and that could be kind of a very purposeful policy pushing in that direction. So I mean, we're lucky enough that a colleague here at LSE, he went to grad school with the global head of HSBC export financing, and in a candid conversation, you know, we posed a question to him. You know, we asked him, so did you know that Peru, you know, HSBC Peru actually is very good at lending to China? Second, you know, have you seen this pattern in other, you know, countries? And third, you know, if you knew, you know, this is kind of your policy. And his answers were, you know, surprising to us. The first was, we know that we see these patterns. Some of our local chapters of our, you know, of HSBC are very good at lending to support certain countries. it's different in every country. So, you know, HSBC Mexico, they're not very good in China. They're very good in Southeast Asia for some reason. And HSBC Brazil is completely different as well. So it's not on purpose. The attempts we have made to actually harness, exactly as you suggested, Antoinette, the attempts we have made to figure out why HSBC Peru is so good in China, and try, because if we learn this, then we can apply it to all the countries, and then we'll be better in, you know, we'll be good at lending to China. But apparently, at the time, this was before COVID, the attempts they had done to systematize what made them better, country by country, ended up all going to kind of local explanations. Like, you know, the HSBC Peru, they had one of the head guys was really, you know, spoke Mandarin, and he was really into China, and then hired all the people, and they acquired. So somehow it was some sort of path-dependent, haphazard process in which, you know, these banks, of course, combined with the freedom that HSBC gave the local chapters to become good at whatever they can become good at, right? So if you have no incentive to become good, that, you know, that this will never happen. But somehow there is some knowledge, and it's kind of the realization that there is some knowledge, but it's extremely difficult to harness. This doesn't mean, of course, that, you know, on the other extreme of this, you have lenders out there that are totally specialized, and it's in there, right? In the advertising, you know, Quicken does mortgages. So that's what they do. They're not diversified. They're good at making mortgages. They do it in a particular way. They have a special technology. They don't even pretend to do anything else. So I think the answer is, you know, you had this is one or the other. It's both. In large banks, I think it's going to be a long time until we figure out exactly, you know, which things are top down and which things evolve naturally as a process. Like in France, for example, these branches becoming specialized locally. I doubt that BNP Paribas is pushing one branch to become an expert in wine and another branch to become an expert in construction. These are just some local guys. They're running the branch to be the best they can, and that's what they become best at. And you end up with kind of this pattern, which may have leading to market power and all sorts of things, but the origin could be something that's completely fortuitous. But so, you know, if in terms of areas of future research, this is a gigantic one in my view.
Right.
Thank you.
In a way, it even pushes us to think about the lending market a bit like, say, the private equity and venture capital market as a matching market, right? Because if indeed there are some, you know, specialization that becomes known, you could worry, or I mean, you could wonder whether some of the better firms in wine are the ones that are realizing, if I just go to Bordeaux, that's where I get the, you know, more sophisticated loan officer, even though I might not be in Bordeaux, right? And so, you know, it really would force us to think much more about the heterogeneity on both the lender and the borrower side, right? Let me.
And just related, another anecdote in the French data, for example, the receivables financing is extremely concentrated. I'm not allowed to say, you know who has the market share, but it's extremely concentrated. And when you look geographically where it quote unquote comes from, it comes from 2 or 3 locations. So this is one example of what Veronica said, that geography for certain types of funding, it's just really not that important. You can do receivables financing from Paris, right? Because the technology is such that all you have to send a certain type of information, and they can issue the credit. So there's you know, once you get into the question, now the nature of the lending changes dramatically. You know, whether specialization matters, how does it matter, and how is it going to show up in the data, and in particular with its relationship with geography. Sorry.
Sorry, Philipp, did you want to jump in? No? Okay. Let me ask one question, another question from the audience, which suggests or asks how we might want to think about political economy factors when thinking about, you know, kind of bank specialization, which I think is something that's actually very prevalent in either countries where, you know, maybe government-owned banks are particularly important, or you were bringing up, you know, internationally global banks, where maybe more and more geopolitical tension might limit, how they want to think about, specializing in certain countries or certain industries and countries where maybe government interference on many different dimensions could become problematic. Do you see this as an important factor in what's going on in banking markets?
So
I know it forces you to speculate even more.
yeah, I don't want to, but there's in Argentina that is keen to having this non-market incentives. There's a famous expertise that is, I'm an expert in regulated markets, and an expert in regulated markets doesn't seem to mean anything good, but it might be a source of expertise that it is out there, it is persistent, and it might not result in the efficiency gains that we are trying to capture here. So it gets into other considerations, but I think it would be fascinating because the mechanisms might be similar. It just ends up affecting the economy in a very different way. At the end of the day, the pattern of specialization that sometimes is by design, sometimes is by accident, that Daniel is mentioning, seems to be good in a sense that we are talking about being more efficient at screening, more efficient, probably even having better terms or lower interest rate for the firms. These firms tend to do better in terms of growth, in terms of exports, in terms of survival. So we can imagine that with banks having different incentives, the pattern of specialization also responds to those incentives. And the same way that you're saying maybe that firm goes to Bordeaux to be associated with that bank, maybe you have another firm that goes to this bank because they know that they're experts in touch firms or something like that. So I think it would be super interesting to get into that type of data and markets to also see potential effects of that kind of specialization.
I think, I find actually that this avenue of research that you are, in a way, have been championing and pushing, right, really also opens the door towards thinking about the organizational economics in the banks, right, and really forces us to think much more about the bank not as this blob of thing that makes loans and is just this homogeneous thing, but really to understand how banks internally function, and how basically all the constraints that we know from org-econ models apply to banks and then translate and transmit into the real economy, which I think is a extremely fascinating area of research. It's obviously also an area of research, as one can see from your work, that requires very good data, but hopefully in this modern digitalized world, we will have better and better data to really answer those type of questions. Given that we're almost at the end, let me ask you in the last minute if you had any suggestions for, say, PhD students who might be watching and who are interested in this area. What's the best way to get involved? Any 30-second suggestion?
Wow, 30 seconds. I guess piggybacking on your comment, the first thing you do is get the data, unfortunately. The hypothesizing, I mean, it's become more and more in vogue to use a structural approach, in which case, you make your assumptions and you make do whatever data you have. This is totally personal, that I don't think there's any substitute for good data. I mean, if you start making assumptions, modeling assumptions, and of course, you can achieve a lot more with less data, but my personal view is that, what you can achieve is very limited by the data that you have.
Okay, maybe very, very briefly, I will try. I think you need a good research question, and I think Antoinette just laid out a couple of them. So I think that's there. As Daniel pointed out, you need the data, so that's definitely something you can look for. And then you need the passion because it takes a long time. So if you have all these three things, I think you're already off to go to a good start. Let me just one thing on behalf of all of us. I also wanted to thank the Journal of Finance for hosting this today, and I wanted to thank the Brattle Group for sponsoring the prize. We really appreciate it, and we really appreciate being part of this podcast. It's a great experience.